Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Today, we are strapping in for the tumultuous, high-stakes world of mergers and acquisitions. Specifically, we're looking at it from the side of the company doing the buying. This is buy-side M&A. And we have to start with a figure that should immediately, well, it should grab your attention. The Harvard Business Review estimates that somewhere between 70 and 90% of M&A transactions ultimately fail.
They fail to deliver their expected value. And that staggering failure rate, it's not just a statistic, it's the whole reason this deep dive is so essential. We're talking about buy-side M&A, a process a company starts to, actively source its own growth.
And it's becoming more common now.
Right. It is. In a climate where equity financing is getting more and more expensive, M&A is just a dominant strategy for companies that need to expand or diversify, and fast. It's deliberate, accelerated growth.
So our mission today is to basically give you the handbook for navigating those huge risks. We're going to unpack the entire M&A lifecycle preparation, finding a target, and most importantly, managing that risk. And we're drawing a lot of this from the great guide, the Buy-Side M&A Handbook from 𝗕𝘂𝘆 Capital.
Right, and they specialize in being that outsourced M&A advisor. Their expertise really matters here, especially in the lower middle market, which we'll see is it's just hyperactive. 𝗕𝘂𝘆's team is led by Bob Brown. He's a former securities and M&A attorney. I mean, he's worked on deals worth over $100 billion for giants like Comcast and Fox, but also advised tiny startups.
That's a huge range.
It is, and that perspective really helps us understand how the process scales, or, how it often doesn't.
All right, let's get tactical then. Before a company can even think about looking for a target, there's the internal prep. You can't just go shopping if your own house isn't in order.
You absolutely can't. The foundational step is all about strategic alignment. Your goals for the acquisition have to be crystal clear. They have to fit perfectly with the company's long-term strategy.
So asking things like, what problem are we actually solving?
Exactly. Are you trying to expand into a new state or country? Are you buying a piece of tech because it would take you 5 years to build it yourself? Or is this purely about scale? About achieving cost synergies by, say, combining two supply chains?
And I imagine that kind of clarity is what stops you from getting distracted by a shiny object later on.
That's it, precisely. If your goal is tech, you shouldn't waste 6 months analyzing a services company just because it looks cheap. So once you've locked in the why, you have to take a hard look at your own capabilities.
Your financial capacity.
Right. How are we going to pay for this? Is it cash, debt, equity? And then you have to review your own market position and even the integration risks that already exist inside your own company.
Hey, this all hinges on the team. I mean, you can't just ask your CFO, who also does payroll, to run a multi-million-dollar deal.
No, you need specialists. And often that means bringing in outside help. You build a dedicated team legal counsel, specialist accountants, and critically, an M&A advisor who leads the whole process. That advisor is like the quarterback for the deal, structuring it from day one to, maximize benefits and minimize surprises.
Okay, that focus on strategy and team, it leads us right into the hunt, finding the actual target. And this is where that lower middle market, which you mentioned, really comes into play. It's fascinating because it's so often overlooked.
It really is. This is the aha moment for a lot of buyers. We just have to look at the data on deal volume. FactSet data for the 12 months ending January 31st, 2023 shows pretty clearly where the action is.
Okay, so give us that breakdown. Where are the deals happening?
Well, if you look at transactions valued under $10 million, there were 12,247 of them.
Over 1,200 deals.
Yeah, and that is way higher than the next tier up. Deals between 10 and just under 25 million, only 587. So the insight for you as the buyer is that the most fertile ground is in that sub $25 million range. The competition might be lower there.
Wow, it completely flips the script.
Yeah.
The biggest opportunities aren't always the biggest companies. It sounds like a smart, prepared buyer could find incredible value in that founder-owned, lower middle market space. But if these companies aren't public, if they're not even for sale, how do you find them?
That's the challenge. I mean, you can do industry research, try to spot gaps, but the most effective way, especially for finding those companies that aren't on the market, is to work with an experienced M&A advisor.
So it's more than just making cold calls. How do they find these unlisted targets?
They use what a firm like 𝗕𝘂𝘆-𝗏𝗂𝗃 calls proprietary target searching. It's a very active process. They're mapping industries. They have deep relationships with brokers and private equity groups. And they use advanced data screening to find companies that are a strategic fit, even if the owner hasn't thought about selling yet. They're basically sourcing the deal instead of waiting for one to appear.
Okay, this feels like the highest stakes moment. You found a target, you're talking. How do you put a price on it? This is where you risk overpaying and sinking the whole deal.
It's the ultimate negotiation lever for sure. There are two main methods we rely on. The industry standard, kind of the starting point, is the comparable company analysis, the CCA.
The straightforward one. You're comparing the target's financials, their revenue, their EBITDA, to similar companies.
Exactly. The big advantage is that it's based on real historical market data. But, and this is a big but, for a private lower middle market company, finding a truly comparable public company is often impossible.
So it just gives you a ballpark estimate.
It gives you a ballpark, but its usefulness is limited.
Which brings us to the second method, the one that tries to look into the future.
Right. The discounted cash flow analysis, or DCF. Here, you're projecting the company's future cash flows out for, say, 5 or 10 years, and then you discount that money back to what it's worth today.
Conceptually, that sounds better. I mean, it captures future growth, which is why you're buying the company. But what if the seller's projections are just wildly optimistic? How do you avoid getting anchored to a crazy high number?
That's the built-in flaw, and it's why the DCF often holds less weight in the actual negotiation. It's a garbage in, garbage out problem. A good advisor has to pressure test those numbers. They run multiple models, best case, worst case, realistic case, and they validate the seller's assumptions before they even build the DCF.
So the seller probably prefers the CCA, and the buyer uses the DCF more as an internal check.
That's a great way to put it. The DCF helps justify the premium you're paying for the synergy you expect to create.
And we should quickly mention there are other tools, like looking at precedent transactions in the same industry, or just valuing the assets. It really depends on the company.
Context is everything. But no matter how you get to a price, the next step, due diligence. This is what separates the winners from that 70 to 90% failure rate.
This is when you move from spreadsheets and projections to what's really going on under the hood of the company. What are the core pillars of a good diligence process?
There are 3. First is financial due diligence. And this isn't just looking at tax returns. It's basically forensic accounting. You're trying to find the real sustainable earnings by removing all the weird one-time expenses or owner perks. If the numbers aren't real, the valuation is worthless.
Then you move to all the paperwork, the contracts, legal due diligence.
Yep, and you're hunting for hidden liabilities. You're reviewing every contract, every lease, every license. A huge focus here is making sure they actually own what they say they own and understanding indemnification.
Which is what exactly?
It's the legal protection the seller gives you against problems that pop up after you close the deal, but that happened before you bought it. It's a direct hedge against future risk.
And finally, you look at the machine itself. The operational due diligence.
And this is the one that gets overlooked most often, especially by buyers who are just focused on the numbers. You're reviewing the actual business processes, the organizational chart, the management team. This is where you spot the risks that cause deals to fail post-close.
HBR mentions hubris, a lack of an integration strategy, poor communication. Those are top reasons M&A fails. Does good operational diligence help you spot those things ahead of time?
It has to. Operational diligence is where your integration plan starts. You're not just looking at the factory floor. You're interviewing key employees. You're assessing culture. Is one company super casual and the other is very formal and rigid? That's a huge red flag. Your operational audit needs to catch that so you can plan for it before you sign the deal.
So, assuming the diligence goes well, maybe the price gets adjusted down a bit, you negotiate the final terms, and you close the deal. But Like you said, closing is just the starting line for the hardest part.
It really is. The post-acquisition period is where that 70 to 90% failure rate comes from. The buyer is now facing massive integration challenges, and the biggest is almost always organizational.
And what does that look like on the ground?
It's those cultural clashes we talked about, but it's also merging critical systems like accounting or sales software. And maybe the most fragile part, keeping the key people. If the star engineer or the founder walks out 3 months after you buy the place, a huge chunk of the value you paid for just vanished.
So you see things like earnouts to keep them there.
Exactly, or golden handcuffs, anything to keep that key talent engaged through the transition.
And the financial risks don't just disappear after you close either.
No, they compound. You might find huge, unexpected costs to integrate everything, which blows up your whole financial model. Or if you used a lot of debt and the economy turns, your financing risk suddenly skyrockets. And legally, you could still find a massive undisclosed problem that those indemnification clauses have to cover.
Okay, so what does this all mean? We started with that terrifying failure rate. If we had to boil this whole journey down to the best practices for success, what are the key takeaways for you listening right now?
First, it's built on strategy. You have to develop a crystal clear M&A strategy that aligns with your long-term goals. Second, prioritize ruthless, comprehensive due diligence across all 3 pillars: financial, legal, and operational. Don't skip one. Third, work with experienced advisors, like the experts at 𝗕𝘂𝘆-𝗨𝗏𝗂𝗏 we mentioned, who can help you navigate and find those unlisted deals. And finally, communicate and plan for integration. Plan for it during diligence, not after the deal is done.
That emphasis on planning really underscores that the goal isn't just closing the deal.
The goal is creating durable, long-term value. A successful deal looks past the short-term win and makes sure the acquisition is a real catalyst for your long-term strategic plan. It means the 10% of deals that work. Those are the ones where preparation really did meet opportunity.
So considering that persistent 70 to 90% failure rate and the focus on financial, legal, and operational due diligence, it leaves an important question for you to think about. Which of those 3 types of diligence do you believe is the one that gets minimized or even overlooked the most by buyers whose main or only focus is on getting the lowest possible price? Something for you to mull over.
Complex journeys require expert guidance, and hopefully you now have a much clearer overview of the buy-side M&A process.
Thanks for diving deep with us. We'll catch you next time.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.